This morning, U.S. inflation just keeps falling. Annual inflation rate eased to 3.2% this morning. The CPI for the month of October, lower than expected, coming in below market expectations. So if you take a look at the CPI here, you'll see what's happened. And, this has really been quite something. So we had this big rally in inflation. Where did this inflation come from? Did Biden create it? Was Biden sitting around figuring out how he could drive up the amount of dollars in the system so that he could create massive inflation? Oh, if it only worked that way. Instead, what happens is there's a thing called a lag effect. So all the things that happened in 2019 and all the things that happened in 2020 all begin to show up in 2021 and 2022 because we have a lag effect, right? So if you're trying to figure out what happened in 2022, don't look at 2022 and don't even look at 2021. You've got to go back because of the lag effect, right? And so the lag effect plays a major, major role here. So we had this real big rip-roaring rally in CPI or inflation. It peaked out in June of 2022. And then since that time, we've been coming down. We were at 9% last July. Now we're at 3.2% annualized. In fact, inflation has fallen around 65% from last year's peak after experiencing the longest strings of monthly declines in well over a century. You'd have to go back a century to see this kind of decline. This kind of increase you can find pretty quickly in history. But this kind of decrease, good luck. You're not going to find this for over a century. So the way the Fed was aggressive on this and didn't have to elevate rates all the way up to 15% as some had feared is really quite stunning. So the Fed, clearly is having the desired effect on U.S. inflation through its aggressive rate hikes. And based on the current trajectory, by the time we get to December, the December CPI could be in the 2 to 3% range, right, by the end of the year. So that's not quite 2%, but we'll be pretty close to it. Now, if you break down the CPI, I always get into these CPI reports because I'm kind of nerdy like that, but I do like to break apart the Bureau of Labor Statistics numbers. And we'll report on it tonight. But when you look at it, you'll see basically that energy costs fell about 2.5% on the month. That was good. That helped. They're down negative 4.5% year over year. Food costs did rise a little bit. They got offset by those energy costs, but food costs rose about 0.3% on the month. They're up about 3% year over year, kind of that almost in line with the CPI. Then you have shelter costs rose slightly. They're up, still elevated. Used car prices fell nearly 1%. They're down 7% year over year. And medical care services rose, but they're down 2% year over year. So the official inflation rate remains historically elevated above that 2% level that they're striving for, but it's continuing to recede. And that's good news, for everybody. And we're happy to see that. We want to continue to see inflation numbers, coming down. Even the official ones, we want to see those numbers coming down. Now, right now, the futures market indicates a 100% chance of no rate hike at next month's Fed policy meeting. So the market has pretty much said, okay, this number indicates the Fed doesn't have to keep hiking rates and higher and higher and higher and higher. No, they don't have to do that because clearly the inflation number continues to come down. So we've slightly adjusted our forecast. We expect no more rate hikes in 2023, but we expect the Fed to begin cutting rates sometime in Q1 of 2024. Yes, it could come as early as December. All depends what happens between now and next month. But now, highly likely, it's going to be Q1 2024. Inflation just continues to come down as we had hoped and as we had expected. You can always try to see the cup half empty. You can always look at it that way, or you can look at the cup half full. We're looking at it right now, and we're saying the cup looks looks half full. Let's be optimists here. Let's hope that this is all going to work out in the wash, right? And that's why we have our investments diversified. That's why we do what we do. That's why we allocate across various asset classes so that we can afford a little optimism in our life.